So we're going to do a quick little exercise because I feel like yesterday's built-in gains portion might have been a little sketchy. And I think we both participated in the sketchiness of it all. I think I didn't give a shit, and neither did you. So we have a cash basis taxpayer, and you guys get to do this on your own. The cash basis taxpayer has CEMP of 10,500, AR of 1,000, land of 10,000, AP of 500, equity of 10.5, and it's a C Corp that converts to S. What is the, well, here, let's do this.
Wait,
I wrote this down.
Oh, it's the fair market. Is number 3 the company's fair market?
Yes. The overall fair market value of the company is 20,000. The land's fair market value is 12. Okay? What is the built-in gain per asset? What is the built-in gain overall? What is the built-in gain tax year 1, assuming only collection of AR and payment of AP? What is taxable income? Those are my questions. And we'll give you 10 minutes to figure it out. And if you're done sooner, great. Emma, are we calling it Emma?
Yeah, sure.
Okay.
Let's
Okay.
I think we got the important.
What is the built-in gain per asset? Emma, who do you want to call on since you're the leader of the pack today? Thomas?
Yeah.
What is the built-in gain per asset?
AR is 0.
The built-in gain of AR is 0?
No.
Oh, sorry, 1,000.
1,000?
Yep.
Okay.
Is AP 500? Is land?
Just 2,000.
Okay.
Oh yeah.
And
And then land is 2 because it went from 10 to 12.
okay. I should have asked this, but are there any built-in losses?
No.
There aren't?
AP? It's like
I like the question mark at the end. AP?
Well, I mean, it's netted against your AR, so I don't know if that's actually built.
This is a deduction. Okay. So you have built-in gain and you have built-in loss. AP how much?
500.
500. Okay. What's your overall built-in gain? Because we have to measure it on an asset-by-asset basis. Did everybody get?
Why is the AR fair market value 1,000?
It is.
Then why is the built-in gain 1,000?
Tax basis.
0.
Because we're on cash basis.
Oh, duh.
Okay. So you did everybody know to convert their balance sheet to tax basis? So what is my tax basis balance sheet?
0.
0, 10, 10, 0,
10.
10. Okay. So what's my fair market value? 1,000,
12.
12,000,
7,500. Goodwill.
goodwill, 3,500,
75.
7,500. Okay. For a total of
2,500.
Do what?
20,500.
Okay.
What?
AP? 500. Equity? 20. And you arrived at the 20,500 because what equation did you use? Assets plus liabilities, or assets equals liabilities plus equity. Shut up, I stayed up till 1 a.m. last night too. Okay? So 20,500. So at that point, you're able to determine the 1,000 was your built-in gain in AR, 2,000 was land, and you have a built-in loss of 500 in your AP. This process, I'm telling you, converting to tax basis, fair market value, inherent gain is useful in so many ways, and built-in gain's just one of them. And what equation did you use to help, Emma?
Ale.
Huh? Ale?
Assets equals liabilities plus equity.
Ale? Is that what you call it?
That's what they taught us.
I've never heard that before in my life.
That,
Hold on, Kaylee, have you ever heard that? Okay. I thought I was just old, which I was going to go with I'm just old, but when Kaylee goes, what the fuck in her eyes?
We've all heard it.
Do what?
You're old. We've all heard it.
No. You have or have not heard it?
Oh yeah,
See, I haven't.
I know.
is it like a Lincoln thing?
Yeah, it's a link.
It's a link or whatever.
I'd be a good club these days.
Okay, so what's my overall built-in gain?
10.5.
10.5 is my overall built-in
Wait,
gain?
10,000.
10, which kicks out of my equity section, doesn't it?
Oh, no, you're all right.
What is my built-in gain tax in year one? Assuming payment of AR and AP.
200.
200, how did you get there?
1,000 minus 500 times 40%.
Okay, 200, everybody follow that? Did everybody get that?
Wait, I'm sorry. Can you repeat that?
AR's 1,000, and then but that's like the built-in gain for that. The built-in gain or built-in losses for AP is 500, so the net is 500 times 40% equals 200.
Okay, did you get that, Tatum? Okay, so what's my taxable income that's going to come out in the K1?
$300.
I like your confidence. Why do you say 300?
That was not confident.
I noticed.
Because you have net 500 built-in gain minus 200 of tax.
Well, you have taxable income. It just happens every item was built-in gain, built-in loss asset. Taxable income started at 500, but we paid 200. And the punchline is you get, when you have a built-in gains tax that you pay, you get that deduction against taxable income. So 500, 1,000 minus 500 gets you 500. We paid 200 in tax. 200 is now a deduction. Net 300 is coming out to the shareholder. So this is a stupid question, and this is actually worth writing down. What is the character of the deduction of the 200? Trent, what do you think?
Ordinary?
Ordinary. Could it possibly be capital?
I don't know.
Could it possibly be 1231?
Still don't know.
Okay. So the rule is, what kind of assets do we have here? We have AR, and we have land. Okay, so let's play with this concept for a second. It is ordinary because the item that generated the tax was ordinary item. But if it's the land and it's capital asset, the deduction is capital. Whatever is generating the tax, the character of that deduction is going to be commensurate with the item that generated the tax. Okay? That is well, and let me ask one more question. What happens in year 4 when I sell the land for $20,000? How much is subject to built-in gains? What's my gain, Emma, if I sell it for $20,000?
10.
Is that my 10? Yes. How much is subject to built-in gains?
10,000.
10,000. How you feel about that, Natalie?
I don't know.
You don't know? Kaylee's saying no. What's subject to built-in gains?
Just the built-in gain for asset. Oh, the 12, so it's
Just the two. Yeah? Okay. It's two. So part of the process, because the asset was worth 12 at data conversion. And the point of built-in gains, again, is what would have been subject to double tax the minute before we converted. Only 2,000 would be subject to double tax. The appreciation that occurred post-conversion from 12 to 20 was appreciation that occurred while you were an S Corp. And since that appreciation occurred while you were an S Corp, it's not subject to double tax because that appreciation didn't exist while it was a C Corp. It existed while it was an S Corp. Okay? You got more out of yesterday than I presumed. What are we talking about this morning? Q subs. Who can tell me what a Q sub is? Kaylee, what's a Q sub? What's the fact pattern? If you were going to tell me to draw something on a whiteboard, what would you tell me to draw? Let's put two squares up here, because that's what Kaylee's telling me to do. Okay, where's my other square? Am I putting the other below it? Okay, what? Then what? There's a line between them. Which one would be the Q sub? Why? No. I saw that exchange. I'll change this to Z because that was a very funny exchange we just had. Z. Z would be the Q sub. So let's talk about what Q subs are, because at the end of the day, I use this, especially transactionally, all the time. I mean, this is something I confront once a month, once a week, I don't know, a lot. Qualified subchapter S, domestic corporation that is owned by 100% by an S corporation. X owns 100% of Z. So we've met that criteria. Eligible to be an S corporation if it were actually owned by an individual. Who cares that it began in 86? Cannot be the same ineligible corporations that we talked about earlier for S corps when we were talking about the definition of, what was that definition? Small what?
Business.
Small business corporation. So that same definition, those same prohibitions exist for a Q sub in the same manner exist for a corporation to have the opportunity to be taxed as a S corp. Parent must elect the Q sub election. Qualified subchapter S subsidiary, that's what Q sub stands for, not a Quiznos sandwich or whatever Nicola wants to call it. And it's treated as disregarded. What does disregarded mean, Lucas? What's disregarded mean?
It's invisible for tax purposes.
And who owns the assets of Z for tax purposes?
X.
X. It's disregarded. No rulings limiting the means to acquire a Q sub. Okay, this is actually a planning strategy. Or this is used quite a bit. A owns both X and Z. A uses Lane & Associates. Lane & Associates is very expensive. And the guy says, I'm tired of paying your bills. Is there anything I can do to minimize my bills? Yeah. You can convert Z into a Q sub. Because, Lucas, a Q sub is?
It's an invisible entity for tax purposes.
So is there any filings?
No.
So how many filings do I have with Lane & Associates after I convert this to Q sub? 1. How many did I have before? 2. So this is a way to minimize my bills associated with Lane and Associates. Well, how the hell am I going to do this? So if Lane says, hey, A, contribute Z shares to X in exchange for X shares. Trent, what do we do? No. What's your standard issue answer?
Diagnose.
Diagnose. How do we diagnose what Lane just said to do? What do we call this transaction? I'm actually chuckling inside. Literally.
Use of acquisition.
What is this?
351.
Who said that? Thank God.
That's a gift card.
Do what?
So that's a gift card.
That's a gift card. Are you shitting me? We sat here for like a day and a half talking about 351 and all the aspects of 351, and everybody went into gridlock as soon as I said, what do we have to do, Trent?
Diagnose.
Diagnose. And our diagnosing ability might have been something below a C there. Because at the end of the day, this we've been talking about this. And are we doctors, Trent?
Nope.
We're not. But we have to diagnose. And when I say, here's the fact pattern, is a client ever going to come in and say, hey, can you walk me through a 351? Fuck no, they're not. They're going to say, what do I do? And Lane's going to say, you're going to contribute the shares to Z in exchange for Z stock. So what is that? A 351. What are my provisions under 351 since we're picking on Trent? What are my provisions?
So 351 is it taxable or tax deferred?
Yes?
357C is there debt in excess of basis?
Yes?
358 is that, I get these two confused, 258, 8 and 362, is that basis in the stock?
It is?
362 is the corporation's basis in the assets.
Yes.
Then I don't like these two. 1223.
1 and 2. I don't care if you get them backwards. Because
Um,
it's tacking for both the shares and
Yep.
in the assets.
And then 168 I7, step in the shoes for depreciation.
Okay? So we have A now contributing their shares to X, Z shares in exchange for X shares. And we end up with A owning X, owning Z. And we have a good 351 because A has control, transfer property, still in exchange for stock of X, has control. There's no 357C problem because no debt went in. We run the traps at 358, who you want to call on? Trent?
Let's go with Sam.
Samantha? What's the formula under 358?
Wow, this is what I'm digging.
Is what?
I have to dig.
Well, that's what we do. I mean, this is about repetition.
Wait, okay, 358. So we did. So we already goes 351, then 357C,
Yep.
and then 358.
Yep.
So we are to the basis part.
Correct.
So it's basis.
Old basis.
Yep. And then boot paid
Yes.
and boot received.
Yes.
and
Yep.
what's the other? Thir-
Gain recognized. Okay. So, old basis. We didn't have any 357C gain. Boot paid, boot received. There was no debt. So it's going to be the basis is going to equal A's basis is Z stock. And then the basis of Z stock in the hands of X is going to be A's basis in Z stock, old basis plus gain recognized, 1223, 1 and 2, tacking. So now you can have this situation pop up by virtue of 351 because somebody says, I am tired of paying Lane's bills. I don't want to do it anymore because I I have legal liability shield at X. I have a legal liability shield at Z. I'm still good. So I put them all under there. And now I've taken my compliance to how many returns? 2? Down to 1. I've accomplished something. So, but what was the definition of the Q sub? Let's see. Samantha, you want to call in? Now I'm going to call you Samantha for the rest of the time.
Okay, that's fine. Jimmy.
Jimmy, what's the definition of how a Q sub looks? Because Kaylee helped me draw it on the board earlier.
It's a domestic corporation that is 100% owned subsidiary of an S corporation.
And we have that, right?
Yep.
Okay. So this is one way that we have an acquisition or create the fact pattern where we have to confront a Q sub, and now we have to learn the consequences of owning a Q sub. Okay. 330H10. Are we here to be experts? TK?
No.
No, we're here to know something. 330H10, all you really know about 330H10, and you went to write this, is that A owns Z. If C buys the shares of Z, they buy the shares of Z, C buys the shares of Z, and it results in B owning C owning Z. If you buy the shares of a company, do you get the step up of basis in the assets of the company? Yes or no? Jack?
Yes.
No. Went completely the wrong way. Because at the end of the day, what you bought was shares in the company. You didn't buy the assets. So if Z had goodwill that had 0 basis, but fair market value of $10,000, and we paid $10,000 to A in exchange for Z shares, well, the basis we have in that C has in Z shares is 10,000. But Z still has 0 basis because we bought the shares. 330H10 says, well, if you have something called a qualified stock purchase, and if you want to remember something about 330H10, you need to remember the words qualified stock purchase, because if you don't have a qualified stock purchase, if this transaction, the purchase of Z shares did not meet the definition of a qualified stock purchase, 330H10 is not applicable. But what 330H10 says, even though the legal transaction is I bought the shares of IC, bought the shares of Z legally, that's what the attorney's contract is going to say. Well, for tax purposes, you pretend that C bought goodwill for $10K, bought the assets, fair market value and basis are now equal. 330H10 is a fiction that you have a stock sale, a legal stock sale, but it's treated as the sale of the assets by Z and the purchase of assets by C. That's what 330H10 does. But even though that's the fiction, Z still exists. And Nicola, what's the definition of a Q-sub relationship?
When a domestic corporation that is 100% owned by a subsidiary of an S corp.
Okay, and under, even though that we have a tax fiction that we bought the assets, legally we bought the stock. So even though legally we bought the stock, we still have parent sub. The same way Lane and Associates said contribution to this entity will minimize compliance, create a parent sub. So there's multiple ways that you get parent sub relationships that you have to confront with a Q sub election. Now, the last one is, and I'm going to hammer on this one. So you might want to write this one down because this is the one I use all the time. Okay, you have A that owns X. A, I'm going to say, is a medical practice. And embedded in the medical practice are patient IDs, patient numbers. I can't think of the words. It's things that you have to register with. The words escaping me. They'll come to me sooner or later. It's your contracts that you're contracting with both government and with insurance companies, and to transfer those contracts is so painful that it's ridiculous. So there are situations where somebody wants the stuff inside of X, but they also want the step up in basis. So going back to the general rule, if Disler, you need to get this one right. Okay? If B buys the shares of A, and A transfers the shares to B, do we get a step up in basis? Why? Because we bought the stock, we didn't buy the assets. When you buy the stock, both for legal purposes and tax purposes, you don't get a step up in basis. So if I have these medical numbers inside this corporation or other things that make it undesirable from a transaction purpose to buy the assets of the company, it makes it hard to have a step up in basis in the assets. I need, for business purposes, to buy the equity of the shares of X. So I say, fine, you can do that. But what we're going to do is we're going to have A form a holdco. A is going to contribute X shares in exchange for holdco shares. In exchange for holdco shares. The result is A owns holdco, who owns X. Now, this is a trick question. A contributed, hey, Trent. A contributed, we're diagnosing, X shares to Holdco in exchange for Holdco shares. What is that?
251.
How do you feel about that, everybody?
You said it was a trick question.
It is a trick question.
But there's no way in God's green earth that you know this, right? Because that looks like a 351. Because what do we do over here? A contributed Z shares to X in exchange for X shares. In this case, we have A contributing shares to Holdco in exchange for, or X shares to Holdco in exchange for X shares. Don't those sound the same? And doesn't that sound like we should diagnose it exactly the same? There's the difference between a good practitioner that knows the rule, a middle-of-the-road practitioner that knows exceptions, and then there's the good, really good ones that know the exceptions to the exceptions. Okay? I use this all the time. This is called a tax-free reorganization under 368A1F, or an F reorg. And somewhere when we get to the 8869, there's going to be a line 14 on Form 8869 that says, did you do a tax-free reorganization under 368A1F pursuant to Rev Proc 2008-18? That's what this is. So what is a tax-free reorganization? Or an A1F? Or an F reorg? The answer to the question is an F reorg. Okay, so what this is what an F reorg, and this is something that this feels like it's expert or closer to expert, and it kind of is, but this is so common in transactions that this, I think, is more closer to basic. This is M&A 101 when you'll see in contracts. I got an email from Ansel or Austin Sabalaskas, and he said, "Hey, is this a 330H10? Because it was an equity purchase." And I'm like, no, this is an F reorg, and he didn't know the difference, and he, because he didn't. I'm not throwing stones. So what an F reorg is? What is an F reorg? An F reorg is a mere change of form. Well, what the hell does that mean? What is a mere change of form? A mere change of form could be, one, I don't like Nebraska law. Nebraska law, bad. Delaware, okay, I'm going to be an idiot. What's the abbreviation for Delaware? DE, that's what my instinct said, but DE, Delaware law, good. So you have to file with the Secretary of State, and you have a corporation in the jurisdiction that you set up. So I don't like the Nebraska law. I have a Nebraska-based corporation. I have to kill that corporation. And I have to reincorporate in Delaware. So I have N and I have D. I have all my assets of N transferred to D. And I kill Nebraska. So I have a new corporation, new EIN, new everything, but all I did was pick up my stuff out of Nebraska and dropped it over into Delaware. And when I did that, it was a mere change of form. So let's pretend I did this. How much do we earn a month? Generally, 100,000. Is that our number?
Sure.
So $1.2 million. If I do this mere change of form on January 1st, take my stuff, drop it into Delaware. Well, let's take this step by step. Lucas, if N, which is an S corp, earns $1.2 million per year, it files its tax return, and A owns N, or Lucas owns N, because I got too many letters now. What's the K1 Lucas gets?
1.2.
Who issued the K1?
N.
N. Okay? If I take all the assets and do this mere change of form and pick up all these assets and drop it over into D on January 1st, and we have $1.2 million that's earned through the year. D, how much did D earn through the year?
1.2.
Who's going to issue a K1 to Lucas?
Would it be D since you killed N?
Yes. Okay? So it's very clear that D is going to issue because it earned all those dollars from January 1st to the end of the year, that D is the obvious choice of giving you the K1. But what if, Lucas, I decide that N transfers the assets on December 31st? This occurs on 12/31, and N still dies on 12/31. How much did D earn through the year? Legally?
Nothing.
Nothing. Who do you suppose is going to issue you a K1 that says 1.2?
I would just be guessing. I don't know.
It's going to be D. Because when you do an F reorg, the resulting N structure is the exact equivalent of your beginning structure. You're going to have a different EIN, for sure, but D is deemed to have earned all those dollars. It's a mere change of form. That's all you've done. So in an F reorg, so for this, that's mere change of form, changing states. A Q sub relationship, when you form a holdco specifically to hold, in this case, X stock, That's a mere change of form. That is just a mere change of form. So if we say that, let's do it this way. If we have A, right, that owns X, and there's 1.2 million that's earned through the year. Who issues the K1? Lucas, who you want to call in?
Except Jimmy.
Jimmy.
Yeah.
X is going to issue a K1 to, or who issues the K1 to A for the $1.2 million of income?
X.
X. If, this is number one, if number two, A forms Holdco and owns X, and we do a Q sub election on 1-1, and X is now disregarded, right? And what's disregarded mean, Lucas?
It's invisible.
It's invisible. All the assets and liabilities are owned by Holdco. So it earns 1.2 million from January 1st to the end of the year. This was formed on January 1st. Who issues the K1?
H.
Holdco. Okay? So number three is if this is 1231 and we do this, A formed Holdco, it owns X and it earns 1.2. X has earned 1.2 since the beginning of the year. Holdco did not exist from January 1st to December 31st. Who issues the K1 to A?
Still Holdco.
Still Holdco. Because this, because it's a mere change of form, is exactly equal to that for tax reporting purposes. So what we do, what did you say this is from a, how's this viewed, Lucas? Disregarded entity?
Yes.
Okay, so now let's go back to my fact pattern of A owns X, which is a medical practice. There are all these contracts that are embedded in A that I can't buy, but I want to get a step up in basis in those assets. So how do I do that? A contributes their shares to Holdco, which results in A having Holdco owning X, which is exactly this, which is a mere change of form, because I do the Q sub. And when you sell X, which we agreed is regarded or disregarded? Disregarded. Who owns the assets, Lucas?
The holding company.
The holding company. So even though I'm selling X interest to buyer, it's as if Holdco is selling the assets. So I use 368 A1F and F reorgs to reposition assets, or reposition the equity in a Holdco structure to get it to a disregarded entity status in order for me to be able to legally sell the stock or equity interest and have the buyer get step up in basis. How often does this happen? All the time. I'm telling you, this, if you want to play with something and really get to know something, this one's valuable. I deal with this all the time. Not a little, all the time. This is literally M&A 101.
Where does B go in that?
What do you mean?
In the resulting, where does the B that's buying the shares, where does that come in?
So now that's a very nuanced question. It really is, because what do we do, Trent? Diagnose. So we have lots of questions about who B is and what the result is going to be on B side. We have lots of questions about once we get into the F reorganization, what do we want to do to X post F reorg in order to affect the transaction, and we're going to touch on some of that. However, okay, since you asked the question and Jack has jumped ahead, it is, what is this to be? What happens? Okay? So I'm going to pretend B just buys X. This is going to blow your socks off. B buys X. Is X regarded or disregarded? Pre-sale.
Disregarded.
It's disregarded. So Holdco sold what? What did Holdco sell? I mean, for tax purposes.
Assets.
Assets. But X, if the Secretary of State, what is X on the books and records of the Secretary of State? Is it nothing? Is it an LLC? Is it a corp? What is it?
Corp.
It's a corp. So does B own assets directly because it was disregarded here? Or does B now own a corp?
A corp.
B owns a corp. So what we're saying is Holdco sold assets, and somehow B bought assets because we get the step up in basis. We all agree on that, I think. So how the hell, when the dust settles, does B own a corp? How the hell does that happen? Well, but let's go back to day one in my amazed disappointment at our ability to diagnose the contribution of stock to the company to minimize the number of tax returns. If we have a fiction that Holdco has the assets, and we have a fiction that B bought the assets, we would also have a fiction that B transferred the assets to X in a 351. Yeah.
So A no longer owns anything after that. Because all the holding company
No. A owns holding company.
But there's nothing in it.
There's cash.
Oh yeah.
Yeah. And generally Holdco is going to be liquidated immediately after. If that's the only asset it has, Holdco is going to liquidate and distribute out the cash out to the shareholder. So, so we have, these are situations where a Q sub can result. A 351 because we went to Lane Associates and said, hey, let's collapse my 6 entities down to 1 because I'm tired of paying for compliance. 330H10 where somebody says, I want to buy the stock and get asset treatment. That's another one. And then the last one we touched on is an F reorg. And all those instances are where S Corp is going to own another S Corp and we have to make a Q sub election to make it disregarded. Uh, 332. This is why I said earlier that 330, when we were going over the corporate liquidations, and we said under corporate liquidations, there's two potential outcomes. And Trent, what do we do? Diagnose. We said that under 332, under corporate liquidations, there were two potential outcomes. Trent, what were the two potential outcomes?
What was the question?
Under corporate liquidation, there are two potential outcomes. What are they?
Is it taxable and tax deferred?
Thank you, Jameson.
Damn.
It was in my head, but I was like, there's no way I'm right.
You what?
It was in my head, but I did not think it was right.
Actually, I only saw Jameson's head coming back around. I didn't actually see her whisper it.
Well, she did.
She didn't?
She did.
Okay, so there's taxable and tax deferred. In tax deferred, what is the fact pattern that we're looking for to
Diagnose.
whether it's tax deferred or taxable? What fact pattern has to exist for it to be tax deferred?
The 80%
Sure, what does that mean? Wayne?
control, like that 80% of control.
Oh, you were so close. Because you mixed and matched concepts. Because 80% is right. You're in the ballpark. But
Okay, but 351 is like when we did the control, like the 357. Okay, so this is just 80%.
it's just 80%, but 80% on what?
That's all I remember.
Okay? Tax deferred. In order to be tax deferred, the parent corporation who's liquidating the sub has to own at least 80% and Z/sub has to be solvent or insolvent? Solvent. Tatum, what does solvent mean?
The fair market value is greater than the debt.
The fair market value is greater than debt. And for a gift card, and if you get it right, you get a gift card.
Oh no.
What other provision do we measure solvency? I said it. Hold on. We'll come back to you there, Scooters. So, yeah, Scooters?
I
Yeah.
don't know.
That might be your new nickname, Jameson, is Scooter.
It was like a whole topic yesterday.
No, it was like one brief comment.
Oh God, I don't know.
Really?
Wait,
Wait, what? Jameson?
I don't know.
Bankruptcy?
Bankruptcy.
I would have never guessed that.
I'm gonna make sure this one has funds on it.
Check now. And if there's not, I'll give you another one because you got screwed. That would be something if you get screwed more than once on that. Okay? So, if we say that A has contributed X to Holdco in exchange for Holdco stock, and X is owned 100% by Holdco, do we meet the definition of it being tax deferred? Or meet the definition of possibly being tax deferred and we diagnose it that way, Trent?
Yes.
You sound very confident.
It's not solvent, is it?
Do what?
Well, it has to be 80% in solvent.
Solvency is measured, Jack, based on the, if this is the balance sheet, $1 million of liability and equity is -$1 million and assets are 0. So both sides of my balance sheet put to 0. Now, if you don't know, just say I don't know. Am I solvent or am I insolvent?
I don't know.
You don't know. Does anybody know if I'm solvent or insolvent?
We don't know the fair market value,
We don't know the fair market value. And why is fair market value important, Jimmy?
because that's, I guess, part of the equation to find out if it's solvent or insolvent.
Okay. So if I said my fair market value is $500,000, am I solvent or am I insolvent?
Insolvent?
Jack, do you know why I said I'm insolvent?
Because it's like you owe more than it's worth. Is that why? Because you have liabilities?
Yes. So I could sell it for $500,000, but I still owe the bank another $500. So the fact that my fair market value is less than my overall debt makes me insolvent. So, but if I said, Jack, I'm worth $1.5 million, am I solvent or am I insolvent?
Solvent.
Solvent, because $1.5 million is greater than my debt of $1 million. So in order to diagnose, Trent, who do you want to call on, because I've picked on you plenty. Emma, we're calling on you. You made eye contact. That was unfortunate for you.
I'm paying attention.
Do what?
I'm just looking at you because you're talking.
Now I forgot my fucking question. How do we diagnose? I'll make up a different question. How do I diagnose whether I have a taxable or tax deferred? If I want to diagnose if it's tax deferred specifically, what elements have to exist?
The 80% and
What does that mean? Because that is good, almost as good as Lane's definition of 80%. 80% of what? I'm a new staff person. You're describing to me what this 80% rule is.
like X owns 80% of Z's.
X owns at least 80% of Z. Parent owns 80% or more of sub. That's your first level of diagnostics. The second level of diagnostics is the sub-solvent. So, who would you like to call on, Emma?
Lane.
Lane. Tell me what she just said. How do you diagnose how do you diagnose
The
the
parent,
tax deferred
parent has to own 80% of the sub,
or more?
and then have to diagnose if it's solvent or not.
Okay. Now, I'm going to tell you a dirty little secret about what do we say about this? F reorgs is a mere change of form. And a mere change of form, stupidly enough, a good practitioner knows what, Thomas?
The basic rules,
Better knows,
even more rules.
really good knows,
Yeah, exceptions to the exceptions.
the exceptions to the exceptions. This is an exception. This is an exception to the exception because I'm hammering into you in order to diagnose whether we have a tax-deferred liquidation. You have to have parent-sub relationship where parent owns at least 80% or 80% or more, however you want to say it, and sub has to be solvent. Well, the solvency requirement is turned off in the F reorg. Because it's a mere change of form. If I have X and over here, A owns X, and I said this is exactly equal to A owning Holdco in X, is exactly equal, solvency doesn't matter because X was insolvent before I did the deal. It's insolvent after I did the deal, but these two are exactly equal. The fact these two are exactly equal under an F reorg means solvency doesn't matter. But every other time, solvency matters in order to diagnose whether we have a tax-deferred liquidation or not. And let's see. Thomas, what are my, what provisions do I have under tax-deferred liquidation? Calling somebody.
Jameson.
Jameson?
No gain or loss?
There's the first one's up there. What's the first line up there say? No. What's the provision?
Oh, 332.
332, 332, 337, 334. Those are provisions. 337 is the corporate level result. 332 is the shareholder level result. And 334 is the basis of the corporate assets received by parent. Okay, so 332, I think what Jameson just said, and it's on the board, is no gain or loss is going to be recognized on the receipt by the corporation based on the property received in liquidation. So 332 is applied at the shareholder level. 337 is applied at the sub level. Okay, distribution of property, complete liquidation, corporation receiving such property. I don't care about any of that. Okay, I don't. Or at least I don't think I do. Okay, and this is what we talked about for the 330H10, where S1 buys Exco shares from A. That's what we talked about when I drew over there. That's the same thing. That's 330H10. And this is the last day, right? I'm tempted to say whoever can answer this is a gift card. What was the words that I said that you wanted to focus in on 330H10? Qualified stock purchase. That was too easy. I'm not going to give a gift card. We'll do a running tally of.
Especially if Chambers knew it, there's no.
You what? Chambers is a rock star.
Hey, why did you delete our points? Me and Nicola's.
I don't like either of you.
I don't know. I don't know. I don't know. I didn't. Did I award a gift card yesterday on that?
Oh, you didn't give either of us
You've
one.
gotten too many gift cards.
I think I deserve one.
You do?
Yeah.
Well, we'll see.
We'll see what.
Okay, let's keep going because we actually do have a lot of ground to cover today, and I'm going to take calling on each other kind of out of your hands because there's a little bit too much. Well, who am I going to piss off? And I don't want to come back to me, so I'm just going to piss you off today. Okay, so qualified stock purchase is where A buys S1 stock, or B buys S1 or XCO stock, B owns S1, and S1 owns XCO, and that is a parent-sub relationship that we have to pay attention to make a qualified subchapter S election, a Q sub election. The F reorg is where A creates S1 and S1 owns XCO. That is another, and we talked about that on the mere change of form. What's this say? Is there a difference between the legal structure and the tax consequences for when a Q sub election is made? I'm not even sure what the hell that means. Let's see. Jack, what's the yes say? Maybe I'll figure out what the hell I'm talking about.
Me, Jack?
You, Jack.
On the previous slide and illustration was up in F reorg using Rev Proc 2008-18. Let's assume XCO owns land with basis of 100,000 and A's basis in XCO is 200,000.
I don't even know what I'm driving at here.
I don't either.
Let's take a nice guided tour, Jack, and see where we're going. This is the structure that mirrors reality. Both corporations are alive, I guess, and are recognized. So that I guess what I'm driving at here, I think, is this is a respected legal structure. I think maybe is what I'm driving at. But this might be where I was drinking at my counter, drawing a slide, not really thinking through what the hell I was driving at.
I mean, the next slide kind of helps illustrate who you're looking at here.
Oh, yay. Maybe I was going somewhere. Okay, so for tax purposes, XCO is liquidated. So, oh, okay. All right, so yeah, let me back up. Now I got my bearings. The point is, there's a legal structure, and that legal structure is respected. And the next slide it says, well, wait a minute. And I have a whole presentation on this, and maybe we should do it for you guys at some point, that says we as tax professionals have to recognize or contend with that, and I envy attorneys on this, and that's a very limited scope, is that we as professionals have to contend with a legal analysis and a tax analysis. The legal analysis says that we have to understand what is occurring that the attorneys are putting together. The attorneys say, in this case, either A contributed X to S1 and we did an F reorg, or we have a 330H10 where S1 bought the stock, and the legal documents are going to say, and I'm going to stick to one transaction. The legal analysis is going to say, or the legal document is going to say, S1 was created, and XCO was transferred to S1 in exchange for S1 stock, and this qualifies as an F reorg. This is the legal structure. The attorneys, when they draft documents, all they got to do is say, we got to create S1, and we're going to transfer the shares of XCO to S1. That's what the legal document is going to say. We have to contend with that. We have to review that document, and then what do we have to do with that document, Trent?
Diagnose it.
Diagnose what the hell it is we have to do. So when we do that, we have legal equals tax. That's one option. The second option is tax equals fiction. I don't know a good way to say that right now. You have to understand there's a tax fiction occurring. you have to be able to, Trent, diagnose and understand there's a tax fiction in play, and understand, since there's a tax fiction in play, what the steps are that we have to complete as tax professionals to quantify the transaction results. So legally, the document says A contributed XCO to S in exchange for S1 stock. That's the legal side. Now for tax fiction, since we're making a Q sub election, and if we did not make a Q sub election, tax and legal are in sync. Since we make a Q sub election, now we have to contend with the tax fiction. And the tax fiction says, for tax purposes, XCO is liquidated, even though it's still alive legally. All assets and liabilities are owned by S1. The following occurs after XCO is contributed to S1. S1 surrenders, for tax purposes, not legally, XCO stock, and XCO surrenders the land, and X is liquidated for tax purposes, and S1 now owns the land, which means, Lucas, that X1 is disregarded. It still exists from a legal perspective, but it's now disregarded for tax purposes. And in order to get to the position of being disregarded for tax purposes, you have to follow the steps of the tax fiction to say the land was distributed in liquidation and S surrendered their stock. And now we have to quantify the taxable nature of each of those steps. What are the tax consequences? See, look at this. I'm back on track because I was pretty confused at the beginning. What are the tax consequences of making the Q sub election? There are three. 337 says, measures the corporate level consequences, which says there's no gain or loss on the distribution of the land by X down to S. 332 says there is no consequence of S surrendering X stock in exchange for the land. 334 says what is the basis of the asset that S receives in liquidation. And we said, because I was having trouble quantifying this or coming up with a good way to articulate the consequence, that when you have a 332, 337, I don't remember my words now. It was the basis of X's assets, the basis of the assets received are always going to equal the basis of the liquidated corporation. Because you have two opportunities, you have two reference points to say what is the basis under 332, 337 if the land has 100,000 of basis in X's hands and S1 has 200,000 of basis in X stock. There are 2 points of reference that you have. One is the land's basis and one's the stock basis. Stock basis loses. You're always going to reference the basis of the asset in the hands of the distributing corporation. So once the liquidation is completed, S's basis in the land is $100,000. And then we have this concept of what, Jameson? Disappearing basis. Because I had basis 200,000 in the stock, which got reduced down to 100,000, but it doesn't matter. That's the rule. There's no way around it. So when you go through this process of saying, I have the medical practice, which I had on the board, in that medical practice, we want to sell the assets. I'm going to create a holdco to own the medical practice X stock. And now I've done this mere change of form where I've gone from A owning X to A owning holdco and X. We have to walk through the tax fiction of 332, 337, and 334. So if we have fair market value, this is actually just getting at what's realized and recognized probably. I mean, we have my favorite definition. We have cash, debt relief. I said the property is worth $1 million, $1 million versus the basis. I have a realized gain of 900,000 and recognized gain of 0 because 337 turns off gain recognition. And I think that's what this, yeah, that's what this says. Then you're going to show the surrendering of X stock that has $1 million of value. Why does X stock have $1 million of value, Samantha? You were? Yeah. Kaylee, why is my stock valued at $1 million? That's what the company is worth. Can you be more precise? Because that's a very close, correct answer.
Well, I guess that's what the asset is worth.
That's what the assets are worth that are being distributed out. You're going to use the fair value of the assets being distributed out of the corporation in order to measure the gain or loss, both under a taxable liquidation and under a tax-deferred liquidation. And under tax-deferred liquidation, you don't care because no tax is being paid. But in a taxable liquidation, you sure as hell want to know what you're going to measure is your proceeds and how you quantify the proceeds, and it's going to be the fair value of the asset being distributed from the corporation. So that's how I got to the $1 million value associated with the value of the stock being surrendered, because that was the value of the assets that are being distributed from the corporation. I have a $200,000 basis, $800,000 realized gain, and a 0 recognized gain. And does everybody understand realized and recognized? There's all sorts of times we have a realized gain. When we have a like-kind exchange, you have a realized gain. I take this building and I trade it for another building. This building's worth $10 million, the other building's worth $10 million. My proceeds on both sides of that transaction are $10 million. If the basis in this building is $2 million, I have a realized gain of $8 million because I've swapped assets. But 1031 turns off the gain recognition under like-kind exchanges, and I recognized 0. There's concepts of realized and recognized that run all through this. On 351, when we didn't cover it, the concept of realized and recognized is embedded in that transaction. Okay, so now I have tax basis of 100,000. Natalie, why is my tax basis in the land of 100,000? Tatum?
That's how much it's worth.
That's what it's worth. Jack, how do you feel about that?
I don't know.
I think that's wrong.
What you bought it for?
That's
Now we're going back to our tax threats.
basis in the hands of the,
Say that again.
because that was the basis of the hands of the liquidator.
That was the basis in the hands of the corporation that was liquidated. That's why we arrived at the $100,000 basis. That's what 334 says. And why I keep hammering on that, it's just not intuitive. Or at least it's not intuitive to me. Okay? Let's see. Okay, this is who can own a Q-sub. And I said it still has the same definition of a small business corporation. A Q-sub has to meet the definition of a small business corporation in order to qualify as a Q-sub, and it has to be 100% owned by a parent S-corp. So there's two elements, and that might be worth writing down on this page as a summary or the takeaway rule for what we're confronting. Because, you know, again, I'm trying to help you be able to apply this, not overwhelm you more than I already have with information, and be able to take away enough information in order to apply the rule. The rule is, has to meet the definition of a small business corporation, and it has to be 100% owned by another S-corp. Okay, a Q-sub election. A Q-sub election can be made, let's see. JD, what's that say?
Just the entire thing.
Yeah, get lit because it's worth knowing.
Filed on Federal Form 8869 qualifies as chapter S subsidiary election. Parent corporation can make a Q-sub election at any time during the tax year. Effective date of election cannot be more than 12 months after the date the election is filed or 2.5 months before the date the election is filed. Possible late filing will be accepted for reasonable cost.
Okay, so 3/15, 12/31, 12/31. Okay, what this says, and actually, I'm not gonna touch that. 2.5 months before the filing date of this election. So that sounds very similar to the 2553, doesn't it? So in order for the Q-sub to be treated as a Q-sub for the full calendar year, you have to file by 3/15. But if you say, you know what, for whatever reason, I want it to be a Q-sub next year. I don't know why you do that, but whatever. You can file it as of 1/1, year 1, with an effective date of 1/1, year 2. And if you do that, I've never done that. I don't know what circumstance I would do that. But on 1/1, year 2, that's when you would apply the rules under 337, 332, and 334 to that corporation. Oh, Jesus, that's small. Anybody read that on your page?
Just 8869 form.
Do what?
It's blurry on the page. Do you just use whichever browser you click on first?
I don't know why.
I don't know, I've seen you click on all 3 of your browser options.
I think the way it's set up up there just confuses me, and if I can just get to the internet, I'm a happy guy. Because I on my own, I generally I'm using Firefox on mine, and I don't know why that is.
Looks like it works good.
Huh?
Nothing.
Are you being a smart ass, Jameson, again? Okay. So, in this case, parent corporation making, and I think I had X and Z, right? That was my facts. Parent corporation making the Q-sub election. Well, part 1 is going to be X's information. It's going to be the parent's name, it's going to be parent's address, service center where the last filing was, EIN, and then part 2 is going to be Z's information in filing, letting the IRS know. And then I said number 14, let's see. Kaylee, what's 14 say? Line 14?
Is this election being made in combination with the section 368A1F reorganization described in Revenue Ruling 2008-18, where the subsidiary was an S corporation immediately before the election and a newly formed holding company will be the subsidiary's parent?
Okay, that's my F reorg that we talked about. I use that box all the time. And oddly enough, going back to the fact pattern where I created Holdco on December 31st and filed this form, the IRS is oddly good at this. I mean, they're not good at a lot of things, but they're oddly good at this. I've never had a problem of them going, okay, you got an F reorg. Okay, I'm no longer expecting a return from Z, even though you told me on December 31st, very late in the year, that Z's now done an F reorg. They expect the return from X. I mean, it's very odd to me that they're good at that. I mean, I've never had one problem. And that is so not like the IRS.
So Z doesn't have to file a final return and like check the box final?
Nope. Nope, and that's a great question because that's a very natural question that goes back to if I create X on December 31st, let me back up. if I had X for the full year, I would file everything on X's return. And I'd issue a K1 from X to A because that's what it is. But putting this together, putting this structure together where X now owns Z and we have this F reorg, the IRS says that's exactly the same as A owning X. There's no final return for X. That's why I said they're oddly good at this. They don't have an expectation to see a Z return. They know it's coming on X. It is odd. Let's see. Okay, I don't care. I don't care. I don't care. I don't care. We touched on this a little bit earlier. But let's do it again. Let's see. Disposition of the Q sub. What happens when X, in this case, disposes of the Q sub? In this case, you have A, who owns X, X owns Z, and B says, I'm going to buy the shares of Z for $10,000. And Z's shares are transferred to B. And going back to what I said earlier, there's two realms that we live in. There's legal and there's tax. So from a legal perspective, Trent, what happens? What documents do the attorneys put together?
What documents do the attorneys put together?
Mm-hmm.
Just sale of a business?
Sale of the business. Emma, how you feel about that?
Said purchase.
Did they sell the business assets or did they sell the business stock? They sold the stock. So from the legal side of things, you have a stock sale. So we've now diagnosed the legal side of the deal. But what happens for tax? We have the disposition of a Q sub. What happened for tax? Let's just issue spot diagnose. Just tell me one thing you think happens. TK?
Some sort of gain you have to recognize. A.
A has to recognize a gain.
X.
X has to recognize a gain.
One of them.
One of them. By virtue of a K1, A would recognize a gain for sure. But the gain calculation is going to be where? X.
Mm-hmm.
Why is the gain calculation going to be at X? Is Z a recognized entity or is it disregarded? It's disregarded. Since it's disregarded, even though we diagnosed the legal side as a stock sale, for the asset side, for the tax side, since it's disregarded, do we diagnose it as a stock sale, Thomas?
No.
What do we diagnose it as?
I don't know.
An asset sale. Okay, because at the end of the day, this is legal. I'll come over here. This is tax. A owns X, and X has goodwill with 0 basis. So for tax purposes, X is transferring assets / goodwill, and X is receiving $10K of cash. Because, again, it's very hard to wrap your head around and to interact that there's a legal reality and there's a tax fiction. Because at the end of the day, X legally sold shares. But for tax purposes, X sold assets. So now, when we do our gain-loss calc, we would say for A, or for X, proceeds, 10K, basis, 0, 10K gain, and then there's going to be a K1 that's going to be issued to A that said 10K from an asset sale. What's the character of goodwill? Is it ordinary? We didn't talk about it hard, though. What's the character of goodwill? You got 1 or 2 chances.
Yeah.
It is capital until it's not. Okay, and I don't want to drill down too hard into this concept, but you should know this now that we're there. Goodwill comes in 2 varieties: purchased and self-created. And what I mean by purchased is X over here has goodwill of 0. Okay, and let's do this 2 ways. Okay, this is number 1. This is number 2. Goodwill. Acquisition cost of 100. Accum 100. Basis 0. What's my basis, Lane, under number 1?
0.
0. What's my basis under number 2?
0.
0. But it has 0 basis because it's self-created. I'm a good businessman. I pulled this business out of the ground. Somebody wants to pay me for my cash flow stream. That is self-created goodwill. However, X bought this company, and $100 of goodwill was allocated on the 8594/1060 allocation / purchase price allocation, whichever term you want to give it. You'll see all 3 in a purchase, possibly in a purchase document. So you have 100 of acquisition cost. You've amortized it over its 15 years, and now it's 0 basis. Both are 0 basis. So now we come back to, well, what character is it, Sam? Goodwill? Capital. What's my favorite answer that's not I don't know and the correct answer? What's my next favorite? Depends. It depends because we have to what, Trent?
Diagnose.
Diagnose whether we're dealing with purchased goodwill or self-created goodwill. If it's purchased goodwill, or excuse me, self-created goodwill, Sam, guess what? Do you think you're correct or incorrect on capital?
And I'm probably incorrect.
No, you're correct.
Oh, I'm correct.
For self-created. Sale of self-created goodwill is always going to result in a capital gain. Sale of, and this blows my mind, right? It literally does. I mean, this doesn't seem fair. The sale of purchased goodwill is 1231/1245. And JD, if I say it's 1231/1245, what's that mean? How do you diagnose the result of that? Let me give you well, it's our facts. Let's pretend this is our facts, that we have self-created goodwill that was purchased for 100, a cum of 10, and we sold it, or of 100, and we sold it for 10,000. I mean, this goes back to, did we cover this in 1? We did. We certainly did. And if you don't know JD, call on somebody.
I don't know.
Kaylee, do you know? Okay, I'm saying that purchase goodwill is a 1231 asset / 1245. And those data points should mean something. Okay, what's that mean?
Well, it blows my mind too, because 1245, we're always talking about like a real tangible asset, or a real depreciable asset used in the business, and goodwill doesn't seem to
TK, a good practitioner, knows. Expert knows. Exceptions. This is F5 maybe? I think it's 179 or 197 F5 maybe?
Yeah.
Was that you, Jack,
Was
or
that
was that
Jimmy?
Jimmy?
That was Jimmy. I'm out of this one.
It sounds right from the class I took last month.
We never covered 197F whatever.
Last month, not last month.
Oh, okay.
Different.
It says that amortization is the equivalent of depreciation for income tax purposes, and 197F5, if that's actually the correct section, is the technical hook that draws it into 1245. So you're absolutely right. You're saying, well, wait a minute. 1245 says that 1231 asset is a depreciable asset or real property that's used in the trade or business for greater than 1 year, and it might be subject to depreciation. And then you have to go down the subset of, is it a building or is it property, plant, and equipment? That's what you just did. And you said, that's neither, right? Which is a great result. Actually, you know what? That is almost, if not absolutely gift card worthy, that you're like, that doesn't make sense. Okay? So, 197F5, if that's correct, is the technical hook that draws it in. So for purposes of your analysis, now you have to pretend, another tax fiction, that goodwill is the same thing as a desk. What's my result? Hold on. Give me that back. Only after you do the analysis do you get this.
Okay.
Let's see what we got. 10K of proceeds. 0 basis. What's the character of my income?
Oh, are we working with situation number 1 or number 2?
2.
2. In which case it's purchased, which would be the same as 1245 asset,
Which should be the same as 1245 asset.
which is ordinary.
What's ordinary? Exactly. How much ordinary do I have?
See, I always remember 1231 is Trent's favorite gain. That's all I can remember.
Trent's favorite gain?
Last time you made fun of him the whole time because you were like,
I did?
We're talking about 1231. He was like, that's my favorite.
Oh, she's almost making me call on you, Trent. Step 1. What's step 1 of quantifying, of diagnosing the gain character? Step 1 is quantify the gain. Did we do that?
Right, yes, we're going to 10K gain.
Okay. Step 2 is, do we have a 1245 or 1250 asset?
We're saying yes because it's purchased goodwill.
Which is it, 1245 or 1250?
1245.
1245. Step 3 is you have to categorize the gain from step 1 into its appropriate bucket.
Right. And does this have to do with, since we have accumulated depreciation of 100, it's ordinary up to that and then capital for the rest?
Capital, you're so fucking close. Capital?
Well, it's 1231,
Is that capital?
not necessarily.
Why? Trent, why?
If you've taken 1231 losses in the past, I think 5 years, you have to recapture it as ordinary income to the extent of losses.
Okay. By vote, am I the deciding vote? Does Kaylee get the gift card?
Yes.
Yes or no? Is everybody on board?
Yep.
Well, I've got overruled. You're getting it no matter what.
What about Trent?
Do what?
Don't deserve one.
Yeah, Trent. You know,
I think
I was just talking about my
That is so fucking stupid. Okay, so I have 1245 gain of 100, 1231 gain of 9900. Okay, but let's go back to the actual facts. Legally, X sold Z. That's legally what happened. Remember, this is tax fiction. So X now has it's done its gain loss calc on the asset sale. So that is the sell side on our tax fiction. Are there how many parties are there to the sale, Lucas?
Two?
Two. The buyer and the
Seller.
who we addressed.
We. The seller.
The seller. So do we have additional work that we need to do?
Yeah, probably.
Okay, so we have tax fiction for sell side. What is tax fiction buy side? Is this okay? Buy side. What is the tax fiction buy side?
like B.
It's
But now it's a corporation.
Okay, so let's stick with Kaylee for a second. What'd you say, Kaylee?
B bought the assets of Z.
No.
Of
Of who? Come on, have confidence.
X.
X. You have so many times go, huh? X? And you're right.
microphone is right here.
Is the microphone that's the problem?
Oh, it's a little bit of me and my.
Let's assign a percentage.
Oh no.
Is it 50% the microphone? 50% you?
Realistically, it's probably like 2% microphone.
Okay. At least we're honest. B buys the assets from X. Jameson, what'd you say after that?
B is now a corporation.
B's a corporation?
Well, it's not a disregarded entity. Oh, not B. Z.
Z is now a corporation. Z becomes corp. So when that happens, hey, Tatum, who has the assets in number one?
B.
B. Jameson, who has the assets in number two?
B. Oh, Z.
Z. Trent, what do we do?
Diagnose.
Diagnose. How, when you see assets being transported out of an individual's hands into a corporation, what's our code sections that we have to run the traps on?
351.
351. So you have an asset purchase. We'll quantify this as asset purchase, followed by what, Trent? You just said it.
351.
351. Because the assets have to be transported out of the individual's hands into the corporation's hands. So we have legal, right? We have legal that we have to contend with. We have tax that we have to contend with. The legal is B bought Z stock from X. That's what the purchase stock is going to say. But then you have to then contend with tax, which we have a tax fiction because Z is a disregarded entity. So now we have a buy side and sell side set of steps that we have to be able to diagnose and know what steps to take. So, Samantha, what happens if Z was not disregarded and we have the same transaction, B buys Z stock?
So then we're saying Z became a corp.
Huh?
Are we saying Z became a corp?
Z is a corp. It's not disregarded.
Okay.
I mean, the starting point is Z is not disregarded.
Okay. And B bought Z stock?
Yeah.
Then, oh. And what happens, you're just asking what happens in general?
Mm-hmm.
Okay, well, B would buy Z and then the gain would go, like Z would have the gain, but then it would also go, it would just trickle all the way up
Okay.
on the sellers.
How does the class feel about this? What exactly, Sam, did X sell?
Well, X owns Z.
Uh-huh. What did X sell?
Disregard. Well, X didn't sell anything. Besides, but
B bought Z stock
that X owns.
that X owns.
So then,
Who's my seller?
well, technically X.
Not tech. It is.
They are.
They're both the seller for tax, under tax fiction and reality. What did, if it's regarded, what did X sell? Z shares. Didn't sell Z's assets. So now there's no step up. X has a capital gain associated with the sale of shares. There's no step up that occurred. In that case, since Z was regarded as an entity, not disregarded, tax and legal are the same. There is no tax fiction. Because what do, Trent?
Diagnose.
And the way you diagnose is by gathering facts, sifting through those facts, understanding what those facts infer and mean, and be able to, Trent? Diagnose. Because by mere change of saying, well, the transaction is fundamentally the same, legally. X sold B stock, or Z stock. And if it's regarded, it's a stock sale. If it's disregarded, it's an asset sale. So when a document shows up on your desk and says, hey, X sold Z stock, you have to have the mental acuity and knowledge to say, well, what's my facts? Is Z disregarded or is it regarded? Is Z a Q sub? What exactly is Z? And then once you make a determination of what exactly Z is, that's when you go down the decision tree of of how to confront that transaction. Because just by merely going from regarded to disregarded changes everything completely.
So that should be your first question.
Well, in this case, sure. Right? But I mean, Trent, what do? Diagnose. I'm diagnosing all the time. My mom, my sister used to say my mom was a question mark because she asked so many damn questions.
Oh God, yeah.
I mean, she had a little hunch to her and she called her a question mark.
I forgot about that.
That's what I am a little bit because I have to go, okay, here's my legal document. B bought X or Z stock. Now I have to go into question mode because I know in my head there's a possibility it's a stock sale. I know there's a possibility it's an asset sale because it's disregarded. And then once I know that it's disregarded, once I make that determination, then I have to ask the fundamental nature or character of how Z is the entity classification. Is it a corp? Is it an LLC, single member LLC? What exactly is it? So when I say, Trent, that we diagnose, it's because you have to have the ability to give this very small set of facts and go, well, based on these facts, this could go 3 directions. Now I have to ask the question to figure out which direction I have to go. And once I figure out which direction I have to go, then I have a more refined set of questions that I have to ask. Because if I say, I get the document that says, Z stock was sold to B, and I say, was Z regarded? Yes. I'm charging off on a stock sale. I know that X has a capital gain, and I know that there's no step up in basis in Z's assets, and my basis in Z shares owned by B is equivalent to $10,000, but the goodwill inside of Z has 0 basis. I'm able to, Trent, diagnose that. However, if they say it's disregarded entity, now I have 2 more questions I have to ask. Is Z a corp for Secretary of State, or is it an LLC? Because if it's a corp, we have those 2 results. B bought the assets, and B transferred them to newly formed Z. If it's an LLC that I'm buying, well, now I have a whole new set of questions that I have to ask. Because a single member LLC is, Lucas?
Disregarded.
Disregarded. But if Lucas and I are buying, if Lucas and I are buying Z, which is taxed as an LLC, then it's
Regarded.
regarded. And at that point, Lucas and I bought assets from X, and those assets were transferred into a newly formed partnership that Lucas and I put together. So when I say that we're not doctors, but we have to diagnose, that is a great example of, I got a single document that says, X sold Z shares. All right, what does that mean? And I have to have the ability to know the set of questions that exist, narrow down based on my first set of questions, then narrow down based on the next set of questions. It's, what is that, Trent?
Diagnosing.
Diagnosing. I do it all the time. Is there any questions about that? Let's see. Natalie, what's this say? Oh, I think that's what we just did, right?
Varied stuff.
Let's see. I think we did this enough, because I do think we need to cover a fair amount today, and I don't want to increase Sam's anxiety that we aren't going to be able to get through this.
I appreciate the consideration.
What time is it? On. Not yet. Just in a second, because we might as well finish this and get back. Z is a Q sub, and just for my own edification, X acquired Z either in a 351 from Lane Associates, or we do, I want to hold co because I want to do a transaction. Can somebody tell me how I do the Q sub election, what is the form, and what are the code sections that apply to do the analysis? Jameson?
Form 8869.
Form 8869.
I was just answering one of them.
Do what? Okay. And what are the code sections that apply?
34.
Oh, that was like a chorus of I couldn't tell what the hell was said, but I'm going to presume that was 330, 332, 337, and 334. And what is, if we were going to make a determination whether this was a taxable liquidation or tax deferred liquidation, what elements have to exist to determine it's tax deferred.
8%
Parent has to own.
and solvency.
Okay, so I'm gonna come back to you, Jack. What did you say, Lane?
The parent has to own at least 80% of the stuff.
Parent
Parent has to own 80%. What did you say, Jack?
They have to be solvent.
Have to be solvent. And does that, in a F reorg, does solvency matter?
No.
It does not. Okay, so termination of a Q sub. You can terminate a Q sub by telling the IRS, I no longer want this to be recognized as a Q sub. Or you can sell it, or you can introduce an owner. If Z issues shares to B, what is the definition of having to be a Q sub? There's two things. 100% owned and has to meet the definition of small business corporation. If we introduce B as an owner into Z, is it now 100% owned? So now we're screwed. So, stupid question. And if you get this wrong, I might cry. Okay? Is before the introduction of B, Z is what?
Disregarded.
Disregarded. Who owns the goodwill?
X.
X. We introduce B, and we go to regarded. What rules do we have to run? Why?
Because X is contributing the assets back to Z.
Exactly. So stupid question. And this really is worth knowing. If, let's say, Z had CEMP of $10 million. Okay? It's a corporate attribute. Let's just say that it has CEMP is a corporate attribute. So broadly, I'm talking about corporate attributes, and I'm picking on a small subset of corporate attributes of C Corp earnings and profits. When you do the Q sub election, and what were the code sections again?
337, 332, 334.
Okay? And all the assets go where for tax purposes? Who owns the land or goodwill after we run those rules for tax purposes?
The parents.
X. Well, guess who also owns the corporate attributes? X. So not only did X get the land, the goodwill, it also gets the corporate attributes. That's code section 381. 381 is a pretty important provision in terms of corporate reorganizations, liquidations, contribution. I don't know. No, that's not true. We'll just stick with those two. So the CEMP moved up into X. CEMP. And it's no longer at Z because it moved up. We now introduce B, and Kaylee rightly said that we're under what provision? 351. So now we have to run the traps of 351, which are 351, 357C, 358, 362, 1221, 1223, 1 and 2, 168 I-7. We all know that at this point. So, does the CEMP come back or does it stay? It stays. Because even though Z on the Secretary of State's books has always been Z, I'm going to say Z1 for purposes of pre-F reorg. For tax purposes, this was Z1. When we introduce B into ownership of Z, it's now Z2. It's not the same corporation for tax purposes. It's completely new. You whatever corporate attributes it had get swept up into parent, and they stay at the parent. So now we converted from Z1 to Z2, and now we have all new accounting elections. We have all new opportunities to treat this as a brand new corporation because that's what it is for tax purposes. Go ahead.
This might be a dumb question, but can they still use the same legal entity name?
Sure.
Okay.
100%. Same legal entity name, same EIN, same everything. Same everything for legal purposes. It's a tax fiction, Sam.
Yeah. Wow.
Okay. We'll call that good for Q subs for now.